Hello everybody and welcome to this TI Talks Global Trade and Logistics with Absolute Strategy Research webinar. My name is Michael Clover, I'm Business Development Manager at Transport Intelligence and I'll be moderating today's session. Today's webinar will first feature an update on the latest logistics data and the implications for global trade. We'll then have a look at the results of TI's March Logistics Confidence Index and then finish with some discussion on how technology might disrupt the air and sea freight sectors over the next few years. The webinar should last a maximum of 30 minutes. Our panelists will be Zahra Ward-Murphy, strategist at Absolute Strategy Research, and David Buckby, economist at Transport Intelligence. Just a bit of housekeeping before we start. Please be aware that there are a mix of ASR and TI clients listening today. And second, while some specific companies may be referenced, you will not be exposed to any material non-public information. I should also just mention that a replay of the webinar will be available to download on both the TI and ASR websites following the call. Now, without further ado, I'll hand over to Zahra to begin her presentation.
That's great. Thank you very much, Michael, and good afternoon or good morning, everyone. So what's going on with global trade at the moment? Last month, I sounded, I think, a slightly more cautious note regarding global trade growth. We did see some slower rates of growth in January versus a very strong pace of growth in Q4. However, it still is, it's difficult to unpick the impact of Chinese New Year timing on these data. And there were still some signs of underlying strength that we could see. Unfortunately, there are still some question marks hanging over the data for February as well. Again, there's difficulties surrounding the timing and the impact of Chinese New Year versus the underlying trend. And in addition to this, we've got a further complication in that February 2016 was a leap year, had one extra business day. And most of these numbers are not adjusted for that. I mean, recall that we like these data because they're straightforward, because they haven't got fancy seasonal adjustments on them, but that does mean that the kinks stay in and we have to try and look through it. So one less day in February this year does dampen the year-on-year growth rates. However, trying to look through all of this and to look forward as well, I think the global trade picture does still look fairly healthy. Airline associations, not typically upbeat animals, they do remain fairly upbeat. And in the US, the National Retail Federation sees strong confidence of both business and consumers underpinning demand. They're looking for double-digit growth in imports at the main West Coast ports in the US in March and April. There are signs of strong demand for shipping goods from Europe back to Asia. And the Eurozone PMI export orders component for March, we had the flash just this week, rose to a 6-year high. So what I'd like to do today is go briefly through some of the data series that I monitor quite closely, and then to pick up on an anecdotal and a thematic point that I think is of interest. So if we look first at air freight, and if we turn here to slide 5, so last month I said early January data suggested relatively strong growth in European air freight, albeit with some moderation from the 8% year-on-year growth that we were seeing in December. That did turn out to be relatively accurate. So with all the components released, our European air freight proxy posted 6% year-on-year growth in January, so down on December's pace. And the overall level of activity here, the dotted gold line on this chart, did drop back from its all-time high. But growth, which is the dotted green line here, is still trending higher and relatively strong. Now, in January, Frankfurt noted strong inbound volumes from Asia as European customers were stocking up ahead of the annual Chinese New Year shutdown, and it was therefore likely that air freight was going to drop back in February. If we now look at the table of growth rates on slide 6 and focus on the February data, which is the second column from the right, we see that Frankfurt air freight growth actually dropped back quite a bit in February, which is 1.6% year-on-year. However, in addition to any impact from lower freight coming in from Asia, these data have not been adjusted for last year being a leap year. And in fact, Frankfurt did note in their comments that without this missing weekday, freight would actually have been closer to 5% year-on-year. In terms of sentiment and the outlook, Frankfurt were actually still positive. They said notable growth had continued in industrial production. and that international trade streams have intensified due to more export orders. And as has been the case in the previous few months, they also noted the weak euro was boosting demand for goods from the region. Overall, German air freight data were released this morning, and they were actually stronger than just the Frankfurt numbers alone. So volumes there were up 3.2% year on year. Again, they're not adjusted for the leap year, so without that, they would have been higher. Elsewhere in Europe, Schiphol in the Netherlands, we see there was robust growth there of 7%. They're actually the only provider I found that do adjust upwards for the leap year. Spain and Italy continue to see 8 to 9% year-on-year growth for the first 2 months of the year if you average out. And without the leap year effect, both could have been close to double-digit growth. If I turn to Asia air freight, and now if we skip to the table on slide 8, and again look towards the right-hand side of that table for the latest data, here we see that China air freight was down in January by about 4%, but then bounced back really strongly at 19% year-on-year in February. And we see pretty much that same pattern across the region, a strong bounce back in Hong Kong, Korea, Japan, and Taiwan. For the region as a whole, according to our proxy, Asia air freight was up just 2% in January and then bounced a strong 16% in February. So we averaged that out in the last column to find activity was up around 8% year on year. So slower than the really strong pace of growth that we did see in Q4, but still robust. And again, remember that leap year effect is in there, dampening the data a bit. In terms of the outlook, IATA, the International Air Transport Association, they actually seasonally adjusted their growth rate to 7% year on year in January. But with all this noise, I think more important is kind of the tone in the comments that they're making. And they said the upward momentum in air freight built up during the second half of 2016 appeared to have continued, and that despite protectionist rhetoric rising, business surveys continued to point to solid growth in air freight in early 2017. This is consistent with comments also from the Association of Asia Pacific Airlines. They put out a press release this morning with their latest data, also saying high levels of business and consumer confidence across most major markets underpins continued optimism for further growth in air cargo demand. In particular, they noted healthy demand for intermediate and finished goods. If I turn now to container shipping, again here we've still got the issue of both Chinese New Year and the leap year to contend with. In the US, West Coast ports had a record January. Inbound containers were up 11% year on year. Activity was boosted by restocking after the US holiday season, and also fuller ships calling ahead of the Chinese New Year, pulling imports forward. And therefore, we were expecting a drop in inbound containers in February. The drop was, in fact, pretty significant. If we go forward to slide 10, we can actually see here the non-seasonally adjusted levels of containers inbound to US West Coast ports per year. So this is non-seasonally adjusted so that we can see the pattern through the year. And the red line is for 2017. So you can see in January, towards the left-hand side of the chart, activity started above all the other lines. That was our record January, but then fell sharply in February for a 16% year-on-year decline. If we look at January and February together, then loaded containers inbound to these West Coast ports were still down around 2% year-on-year. So on the surface, these container shipping data aren't very encouraging. And I think we do have to ask at this point, there's been this ongoing inventory restocking story which has been supporting trade growth. It resulted in a positive contribution to US GDP for the past 2 quarters. Is that inventory stocking story now over? However, I'm not sure we should be too quick to call this. Firstly, that leap year effect, that is dampening these numbers a bit. But second, as we can see on slide 11, the latest inventory shipment data for the US, and these go up to January, are still quite encouraging. If we look at the left-hand chart here, this shows the growth rates in business inventories and business sales or business shipments. We can see that shipments are growing much faster than inventories. And on the right-hand chart, focusing on that red line, that's the inventory shipment ratio. The red line is still trending lower. Inventories are still falling relative to sales. And third, my third reason is that the National Retail Federation and Hackett, they put out this monthly Global Port Tracker report. And in their most recent report, they said they expected double-digit growth for the next 2 months as a growing US economy increases the demand for affordable merchandise. Their view is that consumers are spending more freely and retailers are stocking up for the spring and summer seasons to make sure that they can meet growing demand. They also put out quite a political statement. They noted that imports are essential to providing American families with the products they need at prices they can afford. And they also said, whilst there is this threat of the border adjustment tax and a possible rewrite of NAFTA, which may eventually discourage international trade, they said in the meantime, the opposite is happening. Trade is continuing to grow despite the developments in Washington. Lastly, on these data, Asia shipping, if we look at slide 12, we see here the usual seasonal dip in China container shipping activity in February, albeit that we were starting from a higher level, so we're still seeing volumes grow. 2017 overall still stronger than any of the years that go before it. And if we look on slide 13, we can see the January-February average growth rate for China container shipping was 5% year-on-year. Again, it's more modest than in Q4 when we saw some really strong growth rates, but still okay, and again, dampened a little bit by the leap year effect. A more anecdotal story that I think is really interesting at the moment is reports of a shortage of capacity for shipping goods from Europe to Asia. Now, typically, ships on the return trip from Europe are less full than the ships coming west with the goods from Asia. However, at the moment, it seems customers are struggling to get space on ships going back east. Quoted spot rates apparently are up some in the region of 45%. Shippers don't want to pay this. Customers don't want to pay this. They have to wait for a month or so until they can get some scheduled space coming free. Now, there are some supply reasons for this. After the new year, some of the capacity is down, so not all the ships are running after Chinese New Year, or they're out of position. And also, the shipping lines are organizing themselves. It's common practice in the industry into new alliances, and they kind of reset their service schedules next month, which means that they're sort of repositioning for that. So supply capacity is down, but at the same time, demand is said to be much higher than expected. Remember, we've still got a lot of excess capacity in the container shipping industry, so it should have been able to cope. And Maersk provided some really interesting comments on this during the month. They said domestic policies in China were stimulating demand and hence requiring raw materials. And that's interesting because we'd been talking this story where we had this strong China stimulus coming through from around Q2 last year, which was boosting global growth, boosting trade as well. But we had assumed that that would be starting to fade by now. These comments suggest it may be ongoing. Maersk also noted that Asian imports from Europe for the last 12 to 18 months have been quite low and now required restocking. So again, this suggests stronger activity in China ongoing. And finally, it noted continuing strong demand from Asia in areas such as food and drink products. So that's part of the Asia consumer story as well, feeding in here, rather than just the sort of the Asia stimulus, production and investment story. To ease the situation, some freight forwarders are trying to offer shippers in Europe alternatives. One of those is using southern European ports to use some of those routes, or rail freight out to Asia. And the situation is also boosting demand for air cargo at the moment. AIG actually noted that their volumes were picking up really strongly at 20% already in January to February. But given that this shipping situation appears to have got more acute in recent weeks as well, that does suggest it's going to support air freight numbers for March too. But beyond this near-term story, which, as I say, has some supply and some demand elements to it, what's really interesting to me, I think, is that air carriers have noted a long-term rebalancing of tonnages on key Asia to Europe trade lanes over the last 6 years. And now some are saying that the eastbound air freight tonnages are equal to or exceeding westbound volumes on certain lanes. And this means there is a catch-up in volumes of some 30 to 40% over the last 6 years or so. Cathay Pacific, they agree with this. They said they began to see a reversal in the directional imbalance between Asia and Europe air freight from 2011. And they put this down to the strong purchasing power of growing middle class in Asia, particularly in China, as driving the growth. In particular, they talked about increasing demand for quality food, high-value fashion garments, pharmaceuticals, and consumer products. Lufthansa also in agreement with this, saying that they've seen growing eastbound tonnages over a number of years, and that actually last year exports to eastern China could have exceeded imports coming in from Europe. This is just on the air freight, remember. There's more investigation to be done into the container shipping and seeing if that is rebalancing as well. But I thought it was a really interesting development. It's consistent with the narrative I've been telling about Asia's role in global trade these days, being very much as much about being demand and being a consumer as it is about being the supplier for the global market. It suggests shifting trade patterns. I think it does offer Asia some protection against Trump and potential negative trade developments there. And looking for a theme going forward, I think both Europe and Asia are going to be interested in building on this strong and now more balanced two-way relationship. If the US position shifts, such as the US is only really interested in exporting to the rest of the world, but less interested in filling those ships coming back in the other way, the typically strong trade, which is the imports into the US from both Europe and from China. And just finally, in terms of the near-term outlook for trade, I wanted to point out the latest flash PMIs for the Eurozone, which, as I said, came out earlier this week. As we can see in slide 14, Eurozone goods producers saw the largest increase in export orders since April 2011 in this month. That's that blue line picking up with a lead over the global trade growth rate there, which is currently only about 3%, including everything, including commodities, etc. In terms of implications for equity markets, slide 15 shows that improving trade growth tends to lead better pricing power and stronger earnings growth. So the red and gold lines there are air freight proxy and the manufacturing PMI new export orders, with a lead over the green line, which is global earnings growth. So stronger earnings growth, exactly what we need to see come through to enable US and European equity markets particularly to make further gains from current stretched valuation levels. David, can I hand over to you now?
Yeah, certainly. Thank you very much, Zahra, for your presentation. Good afternoon, everybody. I will kick off with the results of TI's monthly Logistics Confidence Index, as usual, but I'll give you a bit of background on it to start with. So TI has been running the Logistics Confidence Index since about 2013. And to construct it, we survey participants each month on the volumes that they currently experience relative to their expectations, as well as how they expect volumes to develop over the next 6 months. The total index covers 4 European-based lanes, and they are Europe to Asia, Asia to Europe, Europe to US, and US to Europe. Then these trade lanes form 4 sub-indices from which an overall index for both air freight and sea freight is calculated. With regards to the present month, an index value of 50 indicates that volumes are as the market expected. Above 50 indicates higher than expected, and below 50 indicates lower than expected. If you're familiar with the monthly PMI data, the Purchasing Managers Index data published by Market, then it's along similar lines to those. And if you'd like to see the full index report and methodology, then the link is provided on the slide there. But for now, what does the data show for March? Well, broadly, we're seeing a continued positive start to the year, much as Zahra has been saying. So in March, momentum stalled overall in the overall index, dipping by 0.6 points to 54. But that said, we're still firmly in expansion territory, so the market does remain confident overall. Also, compared to a year ago, the index is up by 7.1 points, so really there's still plenty of reason for optimism. Probably the big story this month is that sea freight performance in March, however, was markedly down by 2.4 points to 52.9. So volumes only exceeded expectations in a more muted manner, and that's really the big reason behind the stall in momentum overall. As for air freight, there really wasn't much change month on month. Both the present and 6 month ahead indices remain just above the neutral mark of 50, so we're still in mildly positive territory. Now, if we go on to the next slide, another element to our Logistics Confidence Index is that each month we ask a one-off question on a topical issue, and this month's question feeds nicely into what I'm going to be discussing about tech in air and sea freight a little bit later. So this month we surveyed participants on whether they thought digitisation in freight forwarding would improve from its state in 2016, whereby only one top 20 global forwarder could provide an instant online quote. And the responses were quite optimistic, really. Around 90% of participants concluded that some sort of improvement would occur. So a quarter thought that the number of forwarders embracing digitisation would dramatically increase, while over 60% went for a steady increase. A small minority of 10% predicted that the situation would be broadly the same as what it is now, which we characterise as mostly talk and little action, and the remaining 1.5% were undecided. So this kind of optimistic scenario is hopefully where we're headed. And if we move on to the next slide, I'd just like to take a little bit of a step back and just give an overview of what I'll be talking about with regards to the tech stuff. So first, I'll identify the relevant space in the market that I'm going to be talking about, the specific segment of technology companies that we're interested in. And then I'll go into whether they are likely to be successful in disrupting air and sea freight. And then lastly, I'll examine what the upshot is for the industry in the next few years. So moving on to the next slide, I'll just give everybody a bit of an idea of the companies involved in the world of tech and logistics. This image here, produced by CB Insights, does a really nice job of giving an overview of the whole landscape and the various segments that are covered. And I put a link at the bottom of the slide there, which links to a blog by them, which discusses these segments in a bit more detail and tells you which investors are backing each company. So feel free to delve a bit deeper into that at some point. But for now, the segment that really interests us for the purpose of today's webinar is freight and supply chain visibility. And if we move on to the next slide, I've just taken that segment out specifically so we can see some of the names involved. But first, I should really explain what these companies are doing and offering. Essentially, these companies are either online platforms for freight forwarding services, or they offer solutions which track and monitor a company's physical supply chain. Now, I'm going to concentrate on the companies which are providing online platforms for freight forwarding specifically. So what is an online platform for freight forwarding? Well, it's basically a website that you go to in order to arrange an international air or sea freight shipment. The key difference between one of these tech startup companies that offer this and the traditional freight forwarders is that with the tech startup companies, the process is very quick and painless, or at least it's supposed to be, whereas with traditional freight forwarders, that's not really even widely possible to do that as yet. So if we move on to the next slide, to illustrate the scale of this, this problem, one of these online platforms called Freightos, which I mentioned a little earlier, they were responsible for the question that I alluded to earlier, and they did a mystery shopper type survey to see which of the top 20 forwarders globally it was possible to get instant online freight quotes from in 2016. And Freightos posed as a rapidly expanding US-based importer requesting pricing for a door-to-door ocean freight LCL shipment from a city in China to Chicago. So that's the scenario they were presenting to the top 20 forwarders. And their primary finding was that instant freight quotes were only available through one major forwarder, and that was Kuehne and Nagel. And specifically in 2016, they were the only major forwarder where you could instantly quote multiple modes on their website without a paywall. So for the 19 that didn't achieve that, how far away were they? Well, Freightos said that 17 had some form of online quoting system, and of those, only 15 had working online forms, and then just 10 of them followed up in person after the form was filled out, and only 9 ended up providing a quote. So it's hardly an impressive performance. What sort of cost does that impose? Well, Freightos' study revealed that it took on average 101 hours to manually provide a simple spot, and that was actually 11 hours worse than in 2015. And it also took an average of 15 hours to personally follow up a quote. So moving to the next slide, it's pretty clear that there's a digitization deficiency, if you like, here. But what segments of the market does that really affect? Well, a Drury white paper published in November last year stated that the small and mid-sized shipper, spot shipments, and LCL, those segments would move online extensively. And they stated that through complete web-based forwarding services from instant quotation, booking, up to payment, as well as online sales platforms which dynamically push public and customer-specific rates. And if you think about it, that really does make sense as the natural entry point for e-forwarding, as it were, because these individual spot port-to-port shipments that are highly commoditized, where automation is logically going to be relatively simple. But what about for large shippers who are used to negotiating personally with representatives from carriers directly, or indeed forwarders? Well, these shippers often require a range of complex value-added services too. So you have to ask the question, can this business really be successfully digitized? And that's more up for debate and far less clear. Although, to be fair, Drury does state that the challenge of instant online capabilities for more complex services may be temporary. So they're reasonably optimistic on that front. If we move on to the next slide, well, we've already established that the big forwarders aren't especially digitized at the moment. It's important to know whether the services of the online booking platforms of the small tech startups that are actually in operation now, it's important to find out whether they're actually any good themselves. So in February, the Lodestar did a bit of an investigation into this and looked at a number of the online platforms. Four specifically, they were Freight Filter, Freightos, Containers with a K, and Transporteca. And the Lodestar, their scenario was that they placed standardized search for 2 air freight and 2 sea freight trade lanes. And for a sea freight shipment from Shanghai to Felixstowe, only Freight Filter found quotes on a single 40-foot container. Others only offered LCL shipment prices, not FCL. And for hazardous shipments, all the results came back blank. And even for one of the air freight shipments, Shanghai to LAX airport, one of the platforms humorously quoted the bargain price of £69 with an expected delivery time of over 43,000 days, which is over 117 years. And the company's chief technical officer told them that was a glitch that would be corrected. So seemingly it's not really that slick or hugely impressive. But the common sort of riposte from the online platform seems to be that for now they're focusing on certain routes before building out their capabilities more extensively. So essentially the technology kind of works on a small scale, but they just need a bit more time for it to be rolled out to more routes and more complex solutions. They do in fact insist that in time they expect their technology to be able to process considerations like customs clearance or customs brokerage, specialist handling needs, extreme weather conditions, things like that. So they do seem quite confident in their ability to eventually deal with all sorts of different exceptions. And if they do manage that, then that's clearly going to broaden their usefulness and in turn their customer base. So moving on to the next slide, I'll just summarize all that I've said to this point really. So it looks like that in time, digitization will mean that spot, LCL, port-to-port, standardized shipments will pretty much be able to be booked online rapidly and easily. And that looks most likely to affect small and mid-sized forwarders, which typically provide those standardized services. Though those small forwarders which have niche services or provide specialist services, they're more likely to survive this digitization. But when you introduce more complexity shipments, the online platforms do say that their technology will be good enough in time to handle all sorts of exceptional cases. Others disagree, but overall the jury is really still out on whether the tech can cope with the complexity. What about large forwarders and carriers? Well, I think it's hard to see them being overly troubled by the online booking platforms, especially if they get on the digitization bandwagon themselves, which it really seems like they are in fact doing. I think the trend currently in the market is that we're seeing large carriers and forwarders take the issue of digitization far more seriously. And as a result, they're ramping up investment in upgrading their systems or even looking to buy tech platforms where appropriate, as UPS elected to do with Freightex in Europe, for instance. And yeah, it really is hard to see a scenario whereby a small tech startup takes a sizable chunk of their business, especially when large forwarders, if they have big customers which require door-to-door shipments, which might necessitate things like origin and destination warehousing, possibly supplementary value-added services such as light manufacturing, for instance, as well. I'm not saying that digitization's going to have no impact on carriers and big forwarders. I just don't think it will be particularly disruptive. It's more that in time their service offering will increasingly become more digital. So that's not only in terms of online quotation and booking, but they'll also have far better supply chain overall, and they'll become much more responsive to solving problems because they're digitized. So in a nutshell, online booking platforms and digitization generally will not be particularly disruptive. It's more that digitization will increasingly become a competitive differentiator among large carriers and forwarders for winning business from large shippers. Now, well, that just about wraps it up from me. What I will say, though, before I finish, is that TI has just released a new report called Trends in Logistics Technology 2017, which I've linked to at the bottom of the page there. And that covers the issue of digitization in much more detail, but also other possible threats to the industry, such as carrier disintermediation, cross-border e-commerce and express companies, and also the likes of Amazon and Alibaba potentially becoming substantial forwarders themselves. It also covers a much wider set of issues than that. Its purpose really is to give an overall insight into the various technologies that will shape the future of the logistics industry. So please do take a look at that if you are interested. Thanks everybody for listening. I'll just hand back over to our moderator now to wrap things up.
Great. Well, thank you very much, Zahra and Dave, for your presentations, and thanks to everybody for attending. Do look out for further TI Talks webinars in the coming months. And thanks again, and bye for now.